Welcome back to Investing Talk Podcast.
Today we're looking at American Battery Technology Company.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
The core story here really is a company making this dramatic shift. They're going from being basically pre-revenue, all R&D, to a high-growth commercial operation.
So that sounds like the classic high-risk, high-reward phase.
It is. It's that moment of truth.
That inflection point.
Yeah.
So what do the numbers actually look like? How explosive is this growth?
Well, explosive is the right word. For fiscal year 2025, we saw revenue hit $4.3 million.
Okay.
And, to give you some context, that's a 1,149% increase from the year before.
Wow. 1,000. I mean, that's a massive number, even off a low base. But is that momentum holding up? Or is that just a one-time thing, getting the first facility online?
That's the key question. And the quarterly numbers show it's actually accelerating.
Okay.
If you look just at Q4, revenue was $2.8 million, all by itself.
So more than half the year's revenue in the last 3 months.
Exactly. It nearly tripled compared to Q3. That's 183% sequential growth. So yeah, the momentum is real and it's speeding up.
Okay, but usually with that kind of, hyper growth in a manufacturing business, costs tend to explode right alongside it, sometimes even faster.
Right, you'd expect that.
It's hard to scale efficiently from a standing start.
Right.
So are they just burning cash to get that revenue? What do the margins look like?
And this is where the story gets really interesting and surprisingly positive. We looked at their cash cost of goods sold, the COGS.
Right.
And while it did go up year over year, it grew way, way slower than the revenue did.
So revenue is growing faster than their input costs.
Much faster, more than 2.5 times faster. And that points directly to operational leverage.
Which is, that's the holy grail for a company that's scaling up.
It is. And it gets even clearer in that Q4 data. Revenue almost tripled, like we said.
Tripled, right.
But their cash COGS only went up by 70%.
70% versus almost 200%. That is a huge gap. For anyone listening, what does operational leverage really mean in practical terms here?
It means their big fixed costs, building the plant, getting the permits, buying the equipment, those are already paid for.
They're sunk costs.
Right. So every extra battery they recycle now costs them less and less to process, but generates the same amount of revenue. That widening gap is pure margin. It's the path to profitability.
That suggests some really impressive management discipline. But what about overhead? The corporate expenses, R&D, all that.
This is maybe the most impressive part. Total operating expenses, so everything outside of those direct COGS, they actually decreased.
Decreased. While revenue went up over 1,000%.
Decreased by 30% year over year, down to about 31 million from almost 45 million.
So let me get this straight. Revenue is accelerating, margins are expanding, and corporate overhead is shrinking.
That's the combination. It's the hallmark of a company that's making that transition from R&D to a lean commercial producer.
Okay, that's a powerful story. But as soon as you prove a model works, competitors pile in. What protects this business? What's their competitive moat?
They have a couple of layers. First is their own proprietary tech, their IP, for both recycling and primary mineral extraction.
IP is good, but in the industrial world, sometimes the biggest barrier is just red tape.
Absolutely. And their biggest advantage, I think, is what we'd call regulatory moat.
Okay, what do you mean by that?
Well, you can't just set up a battery recycling plant in your backyard.
Right.
It takes years of navigating complex environmental permits, safety certifications, hazardous waste handling rules. The fact that they're already operational means they've cleared hurdles that would take a new competitor years to even start.
So any new player is literally years behind from day one.
Years. And that time to market advantage is just invaluable. Plus, they have validation from the biggest names out there.
You're talking about the OEM relationships.
Exactly. They just closed out their contract with the U.S. Advanced Battery Consortium, or USCAR.
And for anyone who doesn't know, USCAR is the official link between the Department of Energy and, who is it, GM, Ford, and Stellantis.
The big three, yeah. So successfully working with that group shows you have the trust of the most important customers and the U.S. government.
So they're perfectly positioned for this whole onshoring trend, bringing the supply chain back to the U.S.
Perfectly. Which brings us to their financial health, because you need a strong balance sheet to fund all this building.
Right. It's very capital intensive.
It is. And their balance sheet is surprisingly strong. They ended the fiscal year with about $12.5 million in cash.
Okay.
But then just 2.5 months later, by mid-September, that had jumped to over $25 million.
Wait, so they added almost $13 million in cash in less than a quarter.
They did, which suggests either they're already generating serious cash from operations or they had a very successful capital raise. Either way, it shows confidence.
But the real story with their funding isn't that, is it?
No, the real game changer is the non-dilutive capital.
The huge Department of Energy grant.
That's the one. A massive $144 million grant to build their second recycling facility.
And maybe just quickly explain non-dilutive for listeners.
Sure. It means they get the money without having to sell any more shares of the company. It doesn't water down the ownership of existing shareholders. It's essentially free money to build out their infrastructure.
And when you think about the company's, pretty modest market cap right now, that grant is an enormous piece of the valuation. It's huge.
It is huge. And as of October, they still had about 52 million of those reimbursable funds available. So that's a multi-year runway to build out that next plant without having to tap shareholders for cash.
It just massively de-risks the whole expansion plan.
Mm-hmm.
And speaking of the market, I saw they were added to the Russell 2000 index.
Yeah, back in June. And that's a big structural catalyst.
What does that do for them?
Well, it basically forces all the big index funds and ETFs that track the Russell 2000 to buy the stock.
So automatic passive buying pressure.
Exactly. It boosts liquidity and puts them on the radar of large, active institutional investors who couldn't really touch it before. It's a stamp of legitimacy.
So if the operations have been ahead of the market's awareness, the Russell inclusion is kind of the mechanism that starts to close that gap.
It's the starting gun for that process, yeah.
Okay. Looking forward then. What are the big catalysts people should be watching for over the next, say, 6 months?
Number one, without a doubt, is the Q1 earnings report. That should be out around December or January.
And what are we looking for there?
We need to see that the trend continues. Does revenue growth keep outpacing the growth in costs? Does that operational leverage story get even stronger? If it does, the market will have to take notice.
So that's the proof for the current recycling business. But you mentioned they have a dual-track approach.
Right. The second major catalyst is any news on their Tonopah Flats lithium project.
Which is primary extraction, not recycling.
Exactly, taking lithium right out of the ground. If they can get that project moving toward commercialization, it opens up a second massive revenue stream for the company. It would completely change the scale of their operations.
And then, of course, progress on building that huge grant-funded facility.
Absolutely. Any construction milestones there are huge news, and they keep signing new deals, like that services agreement at Moss Landing, which shows they're expanding and diversifying their customer base even now.
All right, so we've laid out a very bullish case here, backed up by the numbers.
Yeah.
Let's pivot. What could go wrong? What are the big risks that could derail this?
I mean, the biggest one is always execution risk.
They just have to pull it off.
They have to pull it off. The whole thesis rests on them successfully scaling one facility and building another one on time and on budget. Government grants come with a mountain of compliance and red tape. Any delay, any problem, and the timeline gets pushed out.
And what gives you confidence they can handle that execution risk?
Well, two things. First, you don't grow revenue by over 1,000% by accident. They've proven they can scale. And second, successfully working with that U.S. car consortium, with GM, Ford, the DOE, that proves they can navigate complex partnerships. They have a track record.
Okay, what's the other main risk?
Customer concentration. We don't know exactly how much of their material comes from any one partner, but in this industry, you never want to be too reliant on just one or two big OEMs.
Because if that relationship changes, you're in trouble.
You're in serious trouble. But again, the fact they're working with all of the big three, plus signing new deals like Moss Landing, suggests they're actively working to diversify.
So what does this all mean for you, the listener?
I think American Battery Technology Company is a really fascinating play on a huge macro trend, the onshoring of the U.S. critical minerals supply chain.
Right.
You have a company backed by significant non-dilutive government money, and it's demonstrating right now exponential growth and emerging profitability.
I think the real question you have to ask yourself, looking at the data, is whether the market is fully pricing in the value of that $144 million government runway.
That's the core of it. The growth story relative to its current valuation is what makes it so compelling. We'll be watching those Q1 earnings very, very closely to see if this trend holds.
It's a fascinating story.
If you found this analysis helpful, make sure you hit that subscribe button to catch all our future company breakdowns.